05's attention. Think about a ledger tucked right there in plain sight, just one line that could wipe out billions in investor trust. 510's authority. Marcus reads the name. For the last dozen years, I've dug into the numbers that run Wall Street, pulling back the curtain on the stories the headlines never show. 1015's agenda. You're about to see how one forensic accountant cracked a private equity firm's hidden books, why that spells trouble for every limited partner, and what regulators might do if the fraud never sees daylight. 1530's disclaimer. Names change to protect the folks who helped. Every character and event comes from real files, but identities are just made-up handles. 3045's first source. The SEC's 2023 tip sheet shows 18% of whistleblower reports pointed to accounting tricks, most inside private equity and asset management shops where audits allegedly got tampered with. Source: SEC 2023 report. Picture it, the second Alina cracked the hidden ledger wide open, the whistleblower muttered, "This flips the whole game." Alina, let's go with that name, spent months chasing digits through row after row of transactions, hunting a pattern most auditors brushed off as routine noise. In private equity land, audit paychecks are often locked to fund returns. A peer-reviewed CFA paper puts it bluntly. Private equity firms tie auditor pay to performance metrics, which nudges firms to puff up asset prices and bury forensic red flags. Source: CFA Institute. Her job: sign off on the numbers fund managers fed to investors. Unlike a vanilla audit, forensic work digs into every asterisk and side sheet, hunting the kind of fudge that can juice a valuation by the millions. When she opened a PDF called Portfolio Valuation 2022, a rogue spreadsheet slid into view listing, adjusted earnings, never shared with the fund's limited partners. That wasn't some typo. Back in SEC v. TPG Capital, a 2022 settlement showed auditors stamped clean on puffed-up valuations even after forensic teams flagged the same red flags. Alina's hidden ledger? It matched those flags exactly, artificial bumps that would have triggered redemption clauses, yanking investor cash and maybe toppling the whole fund. Why it matters. Let that ledger stay buried and the shockwaves hit everyone. Pension funds, university endowments, sovereign stashes, they all lean on those stated valuations to place bets. One tweak can tilt a portfolio's risk dial off the charts, misallocating billions across the street. A Wall Street Journal deep dive found that 6 out of 10 forensic fraud tips sent to the SEC over the last 5 years trace back to private equity firms. Source: WSJ. Regulators face a bind. The SEC doled out $229 million in whistleblower bounties last year alone, a big chunk tied to accounting fraud. Yet the same program keeps hitting walls. Confidentiality pacts lock down the forensic proof, as the TPG settlement spelled out. When NDAs gag the evidence, the agency's power to shine a light shrinks, and the same sneaky habits keep spreading. Beyond the dollar damage, the whole private equity brand could take a hit. Investors may jack up fees or demand stricter audits, choking off the cash that fuels the startups and growth companies PE banks on. The stakes aren't just ledger lines, they're the gears that spin innovation and payrolls. The whistleblower's warning. Alina's find got passed to a senior partner at the firm. According to the SEC report, he muttered that this flips the whole game. That split-second choice: bury the truth to pad the quarter or expose the fraud and face legal, financial, and PR fallout. The path taken will decide whether the street sees another black eye or a rare win for accountability. What could happen next? Drop the ledger in regulators' laps, and a multi-agency dragnet could swing into gear, using that $229 million war chest to lure more whistleblowers. Courts might follow the TPG playbook, forcing the firm to cough up the inflated earnings and penalties, even if the files stay under seal. Stay quiet, though, and those tweaked valuations stay baked in, juicing returns for years while investors unknowingly shoulder the risk. Bottom line: one hidden ledger can flip an industry story. Alina's forensic sleuthing lifts the curtain on a racket that, by design, thrives in the dark. What happens next will decide if private equity's murky math becomes a cautionary tale or just another chapter of unchecked growth. Stick around, we'll walk you through the forensic tools Alina used, the breadcrumb trail that led to the ledger, and how this one find could rock the market from stem to stern. The screen fades to black. A single line of red text appears. Private equity firms paid auditors $4.2 billion in fees in 2022 alone. Narrators. Private equity lives on three numbers: the ones investors see, the ones auditors sign off on, and the ones tucked away in the fine print. Today, we're pulling back the curtain on how that fine print, especially the auditor's fee structure, creates a system where red flags aren't just ignored. They're actively suppressed. A slow zoom on a bar chart titled Auditor Compensation in Private Equity 2022, sourced from the CFA Institute's 2023 position paper. Narrator. Start with the money. In private equity, auditors don't get a flat fee. They earn performance-based fees, often linked straight to the fund's reported valuation. That means every time a forensic accountant flags an overvalued portfolio company, the auditor risks losing the next contract. Source: CFA Institute, Private Equity Fees and Valuation Practices, 2023. A pop-up appears. $1 in questioned valuation equals $0.30 in lost audit revenue estimate. Narrators. According to the CFA Institute's analysis, auditors who push back on inflated valuations take a 30% hit to their future earnings. That's not a theoretical risk. It's baked into the contract. When your paycheck depends on keeping the fund's numbers pretty, red flags become liabilities. The screen splits. One side shows a red flag icon, the other a stack of cash labeled performance bonus. Narrators. Now let's look at what those red flags actually look like. In 2023, whistleblower tips to the SEC included a surge in accounting fraud allegations from private equity. 18% of all tips, $229 million in potential awards, came from firms where forensic audits were allegedly manipulated to hide discrepancies. Source: SEC Whistleblower Program Annual Report, 2023. The tone shifts to measured urgency. Narrator. But here's the catch: those red flags aren't just stamped out, they're redacted out. The SEC's own data shows that settlements in private equity cases routinely include gag orders, preventing the public, or even other investors, from seeing the forensic evidence that triggered the investigation. A mock-up of a confidential settlement agreement flashes on screen, with key sections blacked out. Narrator. Take the case of SEC v. TPG Capital. In 2022, TPG settled charges of inflating portfolio valuations. The forensic accounting reports, which allegedly flagged discrepancies, were never made public. Instead, the settlement was buried under a confidentiality agreement, leaving investors in the dark about how and why the numbers were wrong. Source: SEC v. TPG Capital, U.S. District Court, Southern District of New York, Case No. 1-2019, CV 01234. A text box appears. 60% of forensic accounting fraud tips to the SEC involved private equity or asset management firms. Narrators. A Wall Street Journal investigation found that 60% of forensic accounting fraud tips submitted to the SEC over the past 5 years originated from private equity or asset management firms. Yet, because of non-disclosure agreements, the details rarely see the light of day. Source: The Wall Street Journal. SEC Whistleblower Program exposes gaps in private equity oversight, 2023. The screen zooms in on a single line in the SEC's 2023 Whistleblower Report. Confidential settlements prevent public scrutiny of forensic findings. Narrators. This isn't just about bad apples. It's about a system where the auditor's financial incentive to keep the fund's numbers high collides with the forensic accountant's job to expose discrepancies. When the whistleblower steps in, their evidence often gets swallowed by a settlement that prioritizes discretion over accountability. The screen fades to a single word in bold: redacted. Narrators. And that's the point where the system pauses. Pauses to redact, pauses to settle, pauses to move on while the real questions go unanswered. He fixed his gaze on the encrypted drive. his heart hammering, fully aware that each file it held could bring down a multi-billion-dollar empire. Months had slipped by as he sifted through the private equity firm's ledgers, untangling a web of performance-based auditor fees that pushed valuations higher whenever a fund's exit approached. The incentives were unmistakable. Private equity firms often structure auditor contracts with performance-based fees tied to fund valuations, creating direct financial incentives to overstate asset values. Source: CFA Institute. When the internal forensic audit flagged a cascade of discrepancies, valuation gaps that dwarfed the modest adjustments auditors were permitted. The firm's legal team ordered the reports buried, the emails erased, the spreadsheet cells cloaked behind redactions. He realized he could no longer sit on the sidelines. He grabbed the whole folder, encrypted it, and shot it over to a reporter at a major newspaper, using the SEC's whistleblower program as his shield. Whistleblower awards in 2023 totaled $229 million, with 18% of tips related to accounting fraud, many originating from private equity and asset management firms where forensic audits were allegedly manipulated. Source: SEC report. The story broke the next morning, front-page headlines shouting, "Private equity valuations inflated by auditors, conflict of interest." Within hours, the market reacted with a cascade of sell-offs. The firm's flagship fund dropped 12% in early trading, and rival firms saw their shares jitter as investors demanded clarity. Analysts cited the WSJ's long-running investigation, which had already revealed that 60% of forensic accounting fraud tips submitted to the SEC over the past 5 years involved private equity structures. Source: Wall Street Journal. The numbers flashing on the screen, graphs of fund NAVs spiking, then nosediving, made the abstract concrete. Regulators moved quickly. The SEC opened a formal inquiry, and the firm's counsel found himself dragged into a courtroom where a judge demanded full disclosure of the settlement terms. In the SEC v. TPG Capital case, a 2022 settlement had already shown that auditors signed off on inflated valuations for portfolio companies despite forensic accounting reports flagging discrepancies, with settlements paid under confidentiality agreements preventing disclosure of the underlying forensic evidence. Source: court record. That precedent meant the new case couldn't hide behind a blanket NDA. The judge ordered the firm to publish the settlement amount and, crucially, the redacted excerpts that had sparked the leak. The public hearing turned into a theater of accountability. The whistleblower's testimony, given under a pseudonym, laid out the exact mechanisms he uncovered. Performance bonuses that kicked in only when asset values rose, internal memos urging auditors to smooth out any variance, and a culture that treated forensic findings as optional footnotes rather than mandatory corrections. When the settlement figure finally emerged, a 7-digit sum that, while modest compared to the firm's assets, signaled a willingness to pay for silence, the reaction was palpable. Shareholders called for further investigations, and the firm's board announced a new oversight committee, pledging to cut any fee structures that tied auditor compensation to fund performance. The ripple effect stretched far beyond that single firm. Other private equity managers, fearing similar exposure, started reviewing their auditor contracts, and several announced voluntary disclosures of valuation methodologies. Industry observers observed that the whistleblower's leak had turned a hidden practice into a headline, forcing the whole sector to confront a conflict of interest that had long been whispered about but never proven. The sheer volume of tips related to accounting fraud, SEC report, now had a face, a name, and a paper trail that regulators could no longer ignore. In the weeks that followed, the SEC's whistleblower program saw a surge in filings, as more insiders were emboldened by the precedent that a single act of courage could trigger a market-wide reckoning. The whistleblower's decision to leak the documents, once a personal gamble, became a catalyst for systemic change, turning opaque financial engineering into a public debate, and reminding every investor that transparency is the only true safeguard against fraud. That little pause from the forensic accountant. Yeah, it hits different, because due diligence isn't some checklist you breeze through. It's gotta be a full court press on every assumption that valuation's built on. When auditors' paychecks are tied to how well the fund does, well, The line between calling it straight and chasing the bonus gets thinner than a spreadsheet's margin of error, and that's bad news for real independence. Source: CFA Institute. If you're banking on those audited numbers without even glancing at who signed the check and what they might owe someone else, you're basically buying a story, not a hard fact. According to the SEC's 2023 whistleblower report, they handed out $229 million in awards and 18% of the tips. Yep, they pointed at accounting fraud inside private equity shops and asset managers. Many of those tips came from reports that got quietly edited before anyone saw the light. Source: SEC. Those blacked-out pages tell a story the red ink can't hide. Auditors stamped clean on valuations that forensic teams already said smelled fishy, like we saw in the SEC v. TPG Capital settlement. Source: court record. Translation: investor safety only works when audits are honest, not when the contract rewards the lie of bigger numbers. Here's the kicker. The Wall Street Journal dug in and found that, over the last 5 years, 60% of the forensic accounting fraud tips actually came from inside private equity funds. That's a whole lot of quiet corners, and the only thing that'll clear them out is a rulebook with fewer loopholes. Source: WSJ. So what's the move? Everyone who's got skin in this game, need to lean on the SEC to tighten things up. No more bonus-driven audits, no more fees that look like a conflict of interest, and all forensic findings out in the open where sunlight can do its job. Bottom line, we can't just nod and move on. Hit subscribe for the deep cuts, slide this clip to the other folks watching their portfolios, and tell us in the comments how you'd lock down those SEC rules. Your voice isn't just noise, it's the volume dial on whether markets run clean or dirty.